Hey guys, Freaky Finance here. This week I'm going to do a video on a company called StoneCo, which I've seen a lot on YouTube about, and most of them capture half of the company anyway. Really, they'll be able to focus on the company is a high grower, company is in Brazil, and it's down a lot, so it appears cheap. And we're going to say those same things because those things are relatively true. But we're going to try to dig a little bit deeper into what's actually driving the model and how how the business actually works. Some parts are easy to understand as we've seen them before, and some parts are harder to explain. So I'm going to attempt to explain them. And if it's still confusing after, it's more a reflection on me trying to explain it than it is on you guys. So let's get into it. So StoneCo started out, I want to say in 2012, mainly as a payment processor, so a POS, so point of sale machine, and really even say this is in Brazil example, so they have reals on here. But in Canada we have merchants, so you'll have like Moneris. Basically, when a transaction is paid on a credit card, both say if it's on a Visa card, the Visa guy will get paid and the payment processor will get paid. And generally these are take rates. And so that's kind of like the core business on one of the lines. And we'll go through the segments on the financials in a bit, but I need some backstory here because it's there's a lot going on. Anyway, so it started as a payment processor. So that's important to understand. So you're going to see them, basically they sell the machines and then they'll also get a percent of each transaction that's run through the machines. But they've expanded their offerings. Let me just translate this to English. They've expanded the offerings to do more. So do you want to sell just with a QR code as well as other things? And really they're trying to cross-sell. So Ton is also for a very small business. It's even a smaller version than this, where on that tab they showed the watch and like this thing that doesn't even have a credit card input. It's only just basically through Wi-Fi to do a transaction. So we'll go through that as well. So they're trying to expand the product offerings. They've also made an acquisition in the software. We'll go through that in a bit. Maybe before I go through an example here, again, I'll translate this to English. This is on the Ton side, so this is really for very small merchants in Brazil. That's kind of their bread and butter. Is that they're trying to bank anybody who's trying to start their own business in Brazil. That's kind of like their goal, and help to make them grow over time is kind of their mission. And they seem to be good at it. They seem to be good at getting people in and keeping them here, which would imply a superior product. And what I mean by that, the churn rate's low, the growth rate is very high. Very high. So well, one of the things we'll go through is one of the reasons why it's sold off so much. One of the reasons why I'm doing the video is because the next quarters I think are going to be relatively good relative to last year. And in the long run, I think it could be interesting. I will disclose that I have a position in this one. I've started accumulating it. This thing's very volatile. It's a Brazilian ADR, and it moves a lot. Like on earnings day, I won't be surprised if this drops 20% or goes up 20%. It's not for the faint of heart, to say the least. And this thing has gone from like 90 to 10, right? My average fill is 9.7, but I mean, it says up 20, but it can go down 20 a day kind of thing. But the value proposition here is interesting. So anyway, before we go through the calculator example, just to see how they kind of get their pound of flesh from the sale that a merchant makes, maybe I'll try to explain some of the business lines. I was going to do the org map, but the org map is very confusing, and it doesn't have a lot of value for the time spent on it. So I will bring up here that they do own 5% of Banco Inter, which has been a mistake for them. They actually took on debt in American dollars to buy this company, or 5% stake in it, and all of a sudden it's go down. We'll talk about that as well. It's actually one of the reasons why mark to market will actually increase in the next quarter anyway. Can't predict the next end of the year, but for September 30th it will have appreciated in value, so they'll have to mark it back up again. But anyway, that's one I'll talk about today, and then Links is another one we'll talk about today, because that's a software stack that is growing well margins are expanding. So let's talk about the revenue lines before we jump into the numbers and maybe that example. So the transactions, so they have a line, a revenue line on the income statement says transaction revenue. And that's basically what it sounds like, transaction revenue. It's their pound of flesh when the transaction goes through on their POS machines, whether that's the Stone or the Ton. It's basically just their pound of flesh. Revenue is recognized net of interchange fees retained by the card issuers. They get the fee, give Visa their cut, or MasterCard their cut, they get the remainder. And their pass-through charges, so they don't take the credit risk on that transaction side. We'll talk about credit risk in a bit. And they have something unique, and it's really important to the income statement, so I want to get into it. But anyway, so the first part's very easy. Second part, subscription. So that's kind of your sub growth. So recognized model as people pay them. The sub revenue, fixed monthly fee, and the related revenue is recognized over time. And then for non-recurring revenue on the software stack, so almost do it like a project. So they'll invoice them in modules kind of thing. Like if they've done 30% of this, they'll invoice 30% of the revenue or cost. Cost for the client with revenue for the company. Financial income is interesting here. There's three things here, and they're really credit products. The last two are loans, so those are the ones that got them into trouble last year, and we'll go through that as well. But the first one is interesting, and I think a lot of people miss this because it's big. Basically, they prepay the merchant. So say if I'm selling a t-shirt, I'm a merchant using Stone's product, and I sell a $100 t-shirt to a client, or customer rather. Say Visa gets their 2%, Moneris gets their 1%, Stone gets their 1%. So you get a $1 going to Stone, $2 going to Visa, $97 going to the merchant. What Stone can do, what the merchant wants, say if the merchant wants the cash right away, instead of waiting for the credit card company to send the money to them once the customer actually pays their credit card off. What Stone is doing is they're saying, okay, well, we'll pay you the money up front and we'll buy the receivable from you. And then what they're doing is they're selling the receivable to this special financial vehicle, FIDC, so FIDC. So basically, they buy the receivable from the merchant and they sell it to these guys, and they basically make a spread. So they'll charge the merchant a fee for doing that, for giving them the money up front. And then these guys, these FIDC guys, because they're selling it to them, they kind of get the money, but they're borrowing from these guys in order to actually buy the receivables in the first place. That's where the cash comes from. So it's like a spread game. So, and one of the things we'll talk about, and it'll be very apparent as you go through the numbers. Maybe I'll go reference this again in a bit. Hopefully you guys can see it. But basically, the CDI rate is like the floating rate. As inflation went higher for Brazil during the first, I want to say 8 months of the year, the current year, so 2022. Basically, their interest expense got very high because these are all floating rates, and interest rates were just going up because they're trying to fight inflation, just like Canada and just like America. So they've been getting squeezed. So what's happening is they have these locked-in kind of fixed contracts with the merchants. They'll pay them this much to basically buy their receivables from them, then they'll sell them to these guys. But they're borrowing from these guys at a variable rate. So as rates increase, they've been paying more to finance this. And at the same time, they're only increasing their prices to the merchant at a lag. So there's been margin pressure is what I'd say. And this is off balance sheet, so it's not like traditional credit where they're the main loan originator. This isn't a loan per se. This is just really they're prepaying the merchant and then giving it to these guys. So these guys take the risk, right? And they basically just try to make the spread at interest rates. But that's the whole game here, in my eyes. Now they do have a credit platform, which they discontinued, and right as of June 30th, 2021, they discontinued it. Now they're starting it up again. The main reason why they discontinued it is that their underwriting standards were not good enough, I believe, for Brazil. And the type of, just in general, you have a lot of small businesses. A lot of them will fail, right? So these guys were actually writing their own loans to the merchants. So if the merchants wanted to expand, they would give them money, kind of stuff, right? Now, maybe they thought they had an advantage because if you're the payment provider, you would be able to see all the revenue coming in, and you could be able to tell if the business is growing and all, but you don't really know what the costs are to run that business. So I think that's where they're coming into trouble, but that's just conjecture. But we'll see if this grows, because this is a big growth driver if they can get credit right. It's not for my purposes of this trade or investment. It will not matter to me right now. It could matter if they get at a hand again, but it's not a growth driver that I need right now for this investment to work because of just how low it's gotten. but it is either a source of risk, a big source of risk, or it's also a source of growth. And I don't really have a feel on if they're good at this or not yet, because they were prudent enough to stop it last year. So they obviously caught the issue early, because it did hurt them, but it didn't blow them up. So we'll have to see what happens in the future with that one. But yeah, I think I kind of talked about their three. So they have their financial services, their software stack. Those are the two segments they break out. So let's go back into the visuals. Back to here. This is gonna be a longer video, just because it's a little bit more complex, and they have more than one type of business. They started as a payment processor. They've slowly built it up to be something much more. So here's the ton program. So again, this is for very small businesses. Pretty much you're your own business. Like, you probably have no employees and you're just trying to make it on your own. And how do you process payments in a cashless world? So anyway, this is what I wanted to show. It's just an example of how things have slowly evolved. So say this is in cash. If they had a $5,000 transaction put through, what would the merchant get? So this is them trying to sell these things to merchants, right? And what would the merchant actually get? So their pound of flesh would be 160 stones, in this case tons, of this sale. So about 3.2%. One of the things that they started doing, and this is also common in North America, becoming more common, is installment payments. But the thing is, the company, like I said, I kind of tried to explain with the prepayment thing. Stone will prepay the merchant. So instead of the merchant having to wait 12 months to get the full pay, or how many months you pick here, instead of the merchant having to wait for that cash inflow, Stone is willing to come in, buy the receivable from them for a fee, and then what they do is resell it again to those Brazilian FIDCs. I'd say the word, but I'm going to butcher the Portuguese language. But anyway, basically, it's still a spread game, but it's even better for Stone. So again, they're borrowing from FIDC to buy these receivables. When they sell them the receivables, they pay FIDC a floating rate, and they charge the merchant these type of rates that they're negotiating right now that we're going to go through. So right now, 3.2% for in cash, so 1 month. But 3 months, you'll see the rate start increasing. It also depends on the product you're using. So if we're using Altaton or Megaton, the rates are different. But we're just going to do Altaton. So, and as we increase, you see Visa and MasterCard, they're not really changing it. Amex is higher. So ultimately depends on the card used, but they're always getting their pound of flesh. And then 12 months, you're going to get the biggest. So this is just to envision it, that you still make that $5,000 sale. Stone gives you all the cash up front instead of you having to get $5,000 over 12 months from the customer, from the credit card, whenever they pay off the credit card. You get the money up front, so you don't have to worry about your working capital. You can keep investing in the business at an aggressive rate, whatever you're trying to do as the merchant, the person who sold a t-shirt. And then Stone basically walks away with $650 instead of just the $160. So basically Stone gets more money at a higher rate. Hopefully that's clear. So that's kind of the business model. And it does help the merchants as well, in a way, if they weren't going to make that sale to that customer. Say if the customer actually didn't have 5,000 reals on them, but they would be able to pay 5,000 reals over 12 months, then they can still get that sale, right? And that's something that Stone provides, is the installment. Very easy to do. And obviously Stone is incentivized for merchants to do that, because they do get more money off them on a per sale basis. And if you can increase the number of sales by getting more customers that wouldn't be able to buy something worth this amount of money, then it also increases the number of transactions, which they also get the fees on, just because more transactions mean more transaction revenue. So it's kind of like a mini flywheel, but really they're just building off each other. A lot of people will go through the presentation because the visuals, like if I look at other YouTube channels, that's all they really do. So anyway, they have their two main segments. They have financial services and software. Lately, financial services margins have been getting squeezed because interest rates have been rising. So as they borrow money from FIDC, that rate keeps going up, and these merchants that they've locked into contracts and have to roll, it is going up, but it's a lag. And so on the leg, you get squeezed on the quarter until inflation stopped peaking or stopped increasing. And I think, well, that's why I'm in it, is because I think it has. And I think margins are going to start opening back up on this financial services line while software keeps doing its growth and margin expansion, as we'll go into on the call as well. So anyway, they break up the financial services really into super small businesses, so they call them MSMBs, and key accounts. The growth that they're seeing on the micro small businesses is insane. Very high growth. Obviously, their product is working. Importantly, it's working both in the ton program as well as the stone. And they've been growing for quite some time at these fairly high rates. This take rate's a little bit misleading, as in this is too low. Basically, they took a hit in revenue in Q2 2021 because of their credit loan book that they had. And so that reduced their revenue. They took the hit on the revenue line, and that reduced their take rate as they calculated. And that's right there in the note too. Significantly lower take rate, mainly explained by the $400 million real effect on our credit product on those revenue for that quarter. Take rate excluding the effect was 2.1 in Q2 2022 and 1.79 in Q2 2021. It has gone up, but not as extreme as this. So basically add 1% to this, you kind of get a more normalized number. But it does show you the issue with the credit loan and how it affects the reporting of the business. And we'll go through that because it shows up like a sore thumb on the quarterly review and doesn't show up. It still shows up on the annual, but it's very easy to see on the quarterly. So banking and credit is another one they've been trying to push, and it also is growing quite well. But right now, for our purposes, it's not critical, but it's where they're trying to go. So they're trying to make it so that not only do we help you make the sale and process the sale, hopefully as cheaply and frictionless as possible, but they're also going to try to cross-sell things, whether it's trying to get your deposits, whether it's trying to sell you a card, like a Stone card, right? Try to cut out Visa and MasterCard and get more fees by using a Stone card. Whether it's expanding the insurance product. So, and they're all growing quite well. Like, obviously, they're starting from a low base here, but they are growing. These are very high annual rates, right? And across the board. So they are doing a good job of converting their existing Stone customers to new products. On the legacy, I thought this was an interesting paragraph here because this is one of the key risks and possibly potential reward. Is that they do have a legacy portfolio. They call it a legacy credit portfolio that they stopped doing because they got into trouble. Of 604 million reals, the fair market value, they already wrote it down to 130 million. So they already took the biggest hit on it that they perceive. But technically that could be another 130 million if they mark it down to zero. They do say there's 509 million that haven't paid principal over 60 days. That's what that means. That's right here in the footnotes. I'm not paid principal for 60 days. So yeah, so they feel like they've took the hit enough on the credit update. That's what that's kind of telling me. Or 97% of the hit they've already accounted for in the provisions that they took last year. And so we'll have to keep our eye on this when they open it up and they come in the same issues again. And obviously they do not have a good grasp on the underwriting standards that are required to lend money in Brazil. Right? The key accounts is interesting. Unlike the small businesses, these are the bigger guys. But you can see what's interesting is that their total key accounts is actually down year over year. So they're growing like crazy on the small businesses. They've actually been kind of stagnant on the key accounts, but the take rate is still expanding, which is exciting. But I did want to bring that up because it's not just like all accounts are growing; it's the small businesses that are really getting a push of growth right now from Stone. The software stack is more new, but you can see the growth here as well. Fairly steady revenue growth, but more importantly is the EBITDA profile has been improving. You've gone from 9% margin last year to 15%, and it was just 12% just the quarter before. They've actually guided to hit 20% by the end of this year, so 3 more months from now. Today is October 9th, 2022. So this is exciting. So whenever you get revenue growth, it's pretty steady with an EBITDA profile that's improving. It's telling me that the software is scaling. or they're able to cross sell whatever when they acquired this company, they're doing something with it that it's working. That's the bare minimum that they could tell me. So this is exciting for me because this is actually very margin accretive to the business because it has a higher EBITDA percent profile currently. So that's exciting too. I thought I'd bring it up because that's also a core driver of the year-over-year improvement. Maybe I'll go through the financials now, and then we'll jump through their comments on the quarter. I think that's probably best. Yeah, it's a lot of information, so you might have to watch that first part a few times because you really need to understand this financial income line. Let's do annual first. So annual over the last 3 years. So first line is just the revenue from a transaction point of view. Second line is revenue from subs. This is not organic growth. They acquired links in 2021. And then they have financial income, which is the prepayment and the credit loan book. So what I mean by prepayments, when they prepay the merchant and then they get the higher fee and then they sell the receivable to FIDC. And the FIDC receivable, so like that floating expense is down here in financial expenses. That's the primary driver. So that's kind of how it flows. So it's kind of misleading to use this as a GMD because it would imply that this financial expense that they incur, that they sell the receivables to FIDC, isn't a core part of the business. So in my mind, they should almost break out this financial expenses line into like traditional like interest expense and then that other companies have, and then also have one that's specifically just for the floating rate prepayment option. That's what I would like to see. But anyway, here is, so you can see very high growth in the net revenue transaction, pretty high growth in sub count, but again, inorganic. And then you have the financial income, which is also a slow, steady grower. And this is with the credit issue write down that they took. They actually took a revenue hit here from the credit book. So because I took the revenue hit here, it skews my metrics here for growth, but there is also some expenses that incurred in 2021 that they got rid of in 2022, which is also good. One of the reasons why I decided to get into it. So anyway, you can see the GMV growing, but again, that doesn't take into account the fact that the interest expense on them from the floating rates going up from inflation killed them, right? It really hurt them last year. It really squeezed the margins on the financial product. What else? So admin and selling, when I go into the 10K, basically they mentioned the links acquisition increased by 134 million. They also had M&A advisor fee for that transaction, which also cost them 74 million. These are all in reals, sorry. At 520 for $1. But yeah, these are all just in reals. It's reals, however you say it. That's what it said. So some of the expenses here are higher. So they also mentioned on the COGS line that they had the links acquisition and tag investments as main reasons. They also invested more into cloud and tech in general last year. That also showed up in COGS. You'll notice they don't really have an R&D line here. What else is there? They also have the mark-to-market investments. We'll talk to that as well. Maybe we'll do that now. So this is the capital market events. June 11th, they raised $500 million at 3.95%. Importantly, this is in US dollars, and this company is Brazilian, so that always is an issue because they're going to have to translate that. So as the US dollar has gotten stronger, they have to translate that debt at a higher rate. So basically, they get hit every time the US dollar appreciates versus the Brazilian real on this debt instrument and translation expense. And there's their five. Basically, they took the proceeds from this bonds to finance our Banco Inter pay investment. They took 5% in. And this company has just gotten destroyed since really traded and started trading. We'll have to see if that's good or bad, right? It's a 5% stake. It looks bad right now, but again, it's marked to market, so if capital markets eventually improve, as they always slowly do over time, you're likely to get most of that mark to market back. Again, it's just accounting noise. But I haven't gone into Banco Inter to see if they're falling apart or not, right? And we'll talk about the chart too. It's very interesting. Looks like someone's manipulating Banco Inter on the NASDAQ around quarterly numbers. With a very small amount of money to make Stone have huge impairments. So I'll go back to the annual. Other expenses not really important for us. Income tax and social contribution, so they have some console. I saw this when we did Veil. I think we did Veil video. another Brazilian, this time in the mining industry. They all just kind of like, they have their income tax and also have a social contribution. Really, just another tax. That's why it's included here. If we add back the mark-to-market value loss, we would have got negative last year. So that explains some of the weakness. But this thing got clocked, right? So this is just a year-end, December 31st cross-section. $42, $83, $11. So this is today's date, 11/64. Pretty sure. Yeah, 11/64 is what it closed Friday. There's slight dilution over time, but you're buying a company that used to be worth almost $12 billion. It actually went up to almost $25 billion US during the COVID bubble, and now it's down to 3.6 billion US on the equity side. I didn't break out the balance sheet or cash flow here. It's a little bit different for bank, especially what they're trying to do. The key thing is to understand this financial income relationship with this financial expenses relationship and understand the drivers for these three revenue things. And we'll see that as we go through the latest quarter. So on the annual, it doesn't look great. The only thing that looks good is that it got cheaper. Now it got cheaper because of this, right? And even if I did take out the mark-to-market value loss, that would have been still a loss year over year, which is the opposite of what you want. You're supposed to start seeing scale at this point. Now there's some good things here that's been very steady. Is one, there always seems to be more and more more growth on the platform, more transactions going through their products. So they're obviously growing well, and their active accounts are also growing very well. So they're growing not only the number of people using the software and the products, they're also increasing the amount that are going through on them. So the businesses that are using them are actually growing, or at least they're putting more on them. So not only are you growing more people on it, you're also making more people that are on it using it more. So this is good. The margins again are a little bit skewed high because they took that revenue hit. So this is just the expense line divided by total revenue. So if they take a hit in credit loan portfolio up here like they did, it obviously makes these all worse. But that's not to say they aren't bad, because they do have these extra links costs in here that they needed to work out. And we're going to see this as we do this last Q2 that they did. It looks really good. So and a part of that's because it looked bad here. And then you have this, which has been an ongoing issue, and one of the reasons why I'm going into it is because I think it's finally reversing. I think interest rates are going to start going down, so their cost of borrowing to prepay is going to go down, and they're going to keep their prices relatively steady until competition starts decreasing their prices, and then they'll slowly start as well. So far, in my mind, I think Stone is one of the more competitive ones, and that seems to be showing up in these metrics. But I don't know that. I'm not in Brazil. Let's go to quarterly. So quarterly's fun. You can really see the... So one, this is just growth. Again, you have links here. So you have your ERP, so your enterprise resource planning. You also have CRM stuff. I didn't really talk about links offerings, but they appear to be steady. And importantly, the financial business is all in Brazil. Software is actually across, I think, 11 countries in Latin America. So obviously the bigger market there for software. And the margins do look good, like they're growing. Like this is growing at a higher EBITDA, right? A part of that's probably just scale, and it is software, so it should be higher margin than a transactional finance business. Anyway, here's the noise. So you can see the hit they took in financial income last year from the credit loan book. It really killed them last year. And this year you can see it bounce back. That's pretty impressive for one quarter. You can see just how big this prepayment installment strategy has done for them. So after financial income, part of that's just the noise. Like I said, that's where they took the credit loan book hit. You can see gross margin looks way better. Again, part of that's just a swing here, but again, it is because the business has been growing fairly steadily. Gross margin dollars obviously looks better. Importantly, both the admin and selling expenses have shown scale, which wasn't the case last year. And part of that is not taking any more credit loan hits up here. So it shows down here that the metrics are actually getting better again. The only one getting worse is, again, financial expenses, which is what I think is actually peaking. So I should still continue to get this growth with this slowly going back down. Or at least that's what I'm thinking. and that's going to be important in Q3 and Q4 this year. The mark-to-market investments are also a large source of noise. So in the last quarter to Q2 2021, they took a big gain, and then in the latest Q2 they took a big loss. They mark-to-market the NTR stock. It's on the Nasdaq, down to $2.10 per share on June 30th. As of September 30th, at $3.26. So because of that alone, we should see some mark-to-market recovery. Basically, that's just translating. Where's Inter? Let's see if this pops. There we go. Yeah. So basically, this is a fun one. So Stone's basically translation for financial accounting for investments. They have to mark-to-market at the end of the quarter. So June 30th, what's the price at? What do I currently had it on my books for the prior quarter? And then I write it up or down. Anyway, here you have June 30th. You have the share price go from $3.40 to $2.10. So a drop of like 33% in a week. And this is when they have to mark the value of the investment. And then, so we wait a quarter, to June 30th. Again, huge volume day randomly. and then you get 326. So, but again, just a little bit ago, a week before the quarter ends, this thing was at 450. So someone's literally slamming this thing down 33% right into the quarter for the last 2 quarters. This hurt them. This is actually still beneficial to them because they marked it down as the value down to here last time, and now it's up here. One of the things Stone has also done poorly with this investment is they started selling it. So they bought a 5% stake, and now they have a 4% stake. So they sold 1% of their investment in a time when only investments have been going down for a lot of people, including these guys. So it looks bad. But again, I don't know what the synergy is here with this bank. What's the ultimate end goal here? But anyway, I thought it was worth bringing up. So we should see it. We will see a gain. We should see a gain in Q3 2022, just because the price has improved from the last time they wrote it down, which was September 30th, 2022. But again, next quarter, today is December 31st, it goes back down to 210. They're going to write it back down again, right? So it's not operating wise, but it will help you on the gain loss when you see an EPS beat, and all of a sudden but really it's from non-operations. Maybe the headline might move it, but the actual business hasn't changed. So let's go to. I think that's everything I want to talk about. Again, you see the same growth. It's so very high growth. I mean, that's over 360 billion now on the platform if I were to analyze this quarter, which is pretty high because the last cutoff was only 275 last year. So it's still growing very materially on an annual to a quarterly basis. So each quarter is still bigger than the last. So obviously you can see they're getting more and more clients, and they're also getting more and more on the platform. Though again, a lot of the clients are small businesses, so people that might actually have 0 employees. It's just them. So very small merchants, micro merchants. But again, you see it across the board. You have all these expenses improving as the revenue grows. Software is also scaling, so the GM margin's getting better. Obviously, it looks way better than the last year because they wrote down their financial income revenue with the credit loan book hit. So this is slightly misleading. This again, actually, a lot of these are, but they are getting better. That's the main thing here. Not as good as this would imply, but still showing scale. And when they break it down in their quarterly numbers, you can see that they talk about they did have non-incurring expenses with links last year. So part of it is the revenue growth scale, and part of it is because they had some extra expenses last year when they first acquired links that they had to work through and integrate. And they mentioned more normalized marketing expenses this year versus last year, which was interesting as well. Again, I think I mentioned, still critical weakness. I don't want to beat this horse, but it's the most important thing in my mind. Well, I'm in it anyway. The annual trend. Well, actually, let's go to financial expenses. So this is important. So this is where that financial expenses line is coming from. Again, these are all floaters. And again, they're linked to that prepayment thing that they're doing. They're trying to pay the merchants ahead of time, buy the receivables off them, sell the receivables to these guys, and they make money on the spread. And that works in a flat interest rate environment. It works in a decline rate environment. It will not work in an aggressively high interest rate hike environment that we have seen. And that's what's happening here, or at least that's my view. And we can see over time how the business has performed. It's actually got to scale in 2018. What I mean by that is actually was able to churn out profitability here. I did so again in 2019, and it kind of did it again in 2020 with some noise. And you can see the growth factors here are both in transactions, so it's growing from the core business. It's also been growing on the sub-service, but again, this went into hyperdrive with the Lynx acquisition. But we can see that the take rate is slowly improving. So it got hit here, but I think we'll see it improve again in 2022, that back half, and then into 2023. And the number of active accounts obviously keeps increasing, and so does the amount. Like that's pretty crazy that your total things that are on your platform have gone from 28 to 209, right? Total volume. That's impressive. That's like, what's that, 5 years, and you've 10x'd your things on your platform, transactions on your platform. That's impressive. I talked about the debt. That's going to be translation. That's going to hurt them this quarter. So you're going to have a fair market value gain on the Banco Inter. And you're going to have a translation expense lost on this bond issuance that they took to make that transaction. What else should I do? Let's go through the call real quick. This is already way longer than I wanted. The outlook for Q3, I think they're going to beat. That's just me. It doesn't really matter. Revenue growth still high. Importantly, they have the EBIT, or the EBT, I guess, because interest expense for a quasi bank, it's never. It's a good metric. So 125 million. So what's 20% growth quarter over quarter? 17% growth quarter over quarter. I'm trying to do math in my head. I think it's around 17. But yeah, anyway, pretty good growth in profitability metric quarter over quarter. That's their guidance. So I'm surprised that it's still down here because it looks like it's inflecting. The cost of service as percentage of revenue. So again, this is them showing their scaling. They talk about it here a little bit. And the selling expenses decreased 4% as a percent of revenue as their marketing expenses turned to more normalized levels. I've already said that on my thing, but again, just to prove what I wrote down, really. They are starting to scale. They did bring up how the financial expenses actually went the other way on them, an extra 7.1%. And their first factor, again, was the increase in CDI rates, because the CDI rates are what they pay the F-dick. Here we go for peaking. So make 100% clear, when interest rates go down, we expect that we are close to peak, as you said. If that trend in interest rates go down, we expect a direct part contribution to our margin. So if we have an ease in interest rates, we expect to capture this as benefits in our margins and our results. Now, inflation might peak, but interest rates will lag that, so we might still have time here. So that's why I'm slowly going to be looking at a cheaper price if the volatility of the markets in general and some calamity unfolds. I can pick up some even cheaper. But because I think I might still have time here on this one. But this makes sense to me. What else? The comment here on headcount, they said, oh, we're actually flattish over the last half year. So that's pretty impressive because they've been growing across all three line segments year over year without having to add new head count. So that's where scale's coming from. What else is there? Competition was interesting. Our players are impacted by CDI almost the same way. So a lot of these guys that they're competing with are all doing the same things. We're not pricing our contracts based on competition. Fine. He says the other players are more stable in their relation to pricing with their strategy. If interest rates go down, some of that will be moving to clients, but I think the industry will keep margins with interest rates ease. That's what I expect. So basically, just like the POS providers slowly increase their prices on a lag as the interest rates are rising, it's basically saying they're going to decrease their rates at a lag as it goes down. Now, it could be a while before that happens, but it is something to keep in your back of your head that the margins will be expanding as interest rates decline, just like they were shrinking as interest rates rose. So that's one of the reasons why I'm in it, because it's kind of a play on interest rates. It's really a riskier play on interest rates because I could just buy bonds, long-term bonds, right? But this is funner for me. Banco Inter. So basically, this is them admitting, like, yeah, we bought this 5% of this company, and we sold 1%, even though the share price has tanked. So you bought high and you sold low. So that's never good. So I just want to point that out. It's not like this investment does not have any risk or any hair on it. One of the things I like about the software profile here is that we've seen this company go, or the software stack go from 9% margins, EBITDA margins, to 12% last quarter, Q1, to 15% Q2, and guiding to 20% by the end of the year. So that's exciting to me, because not only do you have the high growth rate, but you also have the margin expanding. And I thought I'd be worth bringing that up here because that's where they mention it. The cadence of repricing. So again, this brings it back to the interest rate point. And now in July and August, so this will be the Q3. July and September that they'll report, and probably the end of October or middle of November. Basically, they said that we've already did significant movement already, just in August. So we should see more repricing, but this is when inflation peaked. So at least we'll stop seeing the CDI keep coming up, or we should. Well, maybe not this quarter, but fairly soon. And why do I think that is mainly because the inflation rates in Brazil have just started to turn and collapse. So they really accelerated. So this is just the Brazil inflation rate. They really accelerated throughout this whole year, and it's been putting pressure on this whole year. And now we've finally seen it max out here and start dropping pretty quickly. We'll have to look because they do have a readout here really early. Oh, God, 2 days now. From 2 days from now, we'll get the readout for September's inflation. Right? Obviously, if inflation stays high, then pretty much the core of my investment thesis is gonna be delayed, right? And so this thing will just sit around flatter for longer, kind of like it already has, at least recently. But eventually, I expect this to come back down. It already has, so we should start seeing margin expansion, as the interest rates should follow the inflation rate. But that's just my opinion. Doesn't mean it's actually going to happen. So far, central banks are not doing what I would do, at least the American one. Cadence of repricing. So again, I wanted to bring up that inflation chart because it kind of tells you. So inflation was still going up, but they were still raising their prices in August, and inflation peaked in that April, May, June. So we should see it start as inflation goes down. We should see that CDI rate go down at some point, right? And then the margin should expand because they're still raising rates on the leg while the thing flatlines, and then it starts going back down, and then they should get expansion, and they'll slowly decrease prices if they have to, if competition starts decreasing prices. That's the really the consensus here in my mind. I think that's everything I wanted to talk about. Oh, this one was asking about how you're going to get the software stacked 15 to 20%. Combination of those elements, a combination of top line growth or efficiency. The fact to be able to grow, yeah, so really it's scale. You just outgrow your core expenses. And that's usually what software does. It scales very well. I did think this was interesting. So they improved efficiency in some costs, like cloud cost negotiation. So that's good. So that's permanent for this quarter anyway. So that's kind of interesting, right? So it's really just scale. And unlike other targets, this is something that they've already taken the margin from 9 to 15 in a year. So the guide to 20% isn't that aggressive in my mind, especially for software. I'm surprised it's as low as it is. But again, that's just my opinion. I think I already talked about inflation rates. God, this is a long video. All right. Anyway, here is the main holders of it, of Stone. I think a lot of people just did this one because Berkshire was in it, and I think ARK was in it. But you can see Berk's position's only 38 anyway. 38 of their. It's not a huge position for them, even though it is 82 million. They do own 3% of it, but it's not. You don't own something because someone else owns it, right? And they haven't been adding during this entire pullback, which is interesting. I think that's everything I want to talk about. The Stone chart again looks like death, even though the business has been growing materially, and the latest quarter shows that. Actually, the last 2 quarters show that this thing has still been beaten down. And what I'm expecting is the margin profile expands. over time on the financial expenses. Well, the software also scales like they're guiding to. We should start seeing continued profitability, and especially year over year. There's like 2021 was pretty bad, so when they do their annual 2022 versus 2021, it's going to stand out, I think. And then they should be guiding, assuming if they're thinking interest rates will start declining, they should be guiding for margin expansion on 2 of their 3 main lines, and also getting a margin expansion in software with a fairly high growth profile that has been steady throughout this whole little mini bubble. Like you can see the COVID panic, this thing went down to 17, shot up to 90, and then went down to this area, this 9, 10, 12 area where it's been sitting for quite some time. So anyway, that's Stone. It's a fun one. It's a little bit more evolved as a business model, so it's harder for me to articulate it well. But hopefully you guys found this interesting, and have a great rest of your weekend.